Dive into it, guys. All right. So first class, I'm excited. We're gonna start rolling out classes, and we're gonna start off with fibs. So the art of fibs, COVID fibs, mastering Fibonacci retracement for trading, presented by me, Andre Three Stacks. Let's get into it. So, introduction to fibs. Who was Leonardo Fibonacci? These are some of the things we're going to be going over. What is the Fibonacci sequence? Where do the numbers originate from? How do we apply them to technical analysis and trading? You'll also notice the Three Stacks logo here. This resembles Fibonacci as well. If you don't see it, you will see it by the end of this presentation. So who is Leonardo Fibonacci? His actual name is Leonardo Paisano, and he's better known as Fibonacci. He lived in the 12th century. He's regarded as the most talented Western mathematician of the Middle Ages. He's most famously known for his number sequence, and this sequence is present in nature, human behavior, constellations, the Three Stacks logo, and many other examples. It's simply the blueprint of the macro and microcosms of the universe. What is the Fibonacci sequence? Specifically, it's a series of numbers starting with 0 and 1, where each subsequent number is the sum of the previous two numbers. So let's take a look at this graphic right here. You can see 1, it starts with 0 plus 1, which would get you 1. Then you add the previous two. 1 plus 1 equals 2. 1 plus 2 equals 3. So on and so forth, and it gives you these patterns that kind of unfold, and this creates kind of like a spiral outward, meaning it's proportional to all the previous numbers, which creates a perfect sequence. And you'll find this all throughout nature, like I mentioned, and architecture as well. Where do the numbers originate from? The sequence is derived from the golden ratio. The golden ratio is 1.618, and the inverse of that is actually 0.618. You don't have to look too far to see real-life examples, from the way the universe is formed to weather, plants, seashells, the list goes on, and you can see the spiral effect that it creates. These cool little spirals from a galaxy, flowers, plants, weather patterns, seashells. Now, Fibonacci and trading. The Fibonacci retracement used to identify potential levels of support and resistance. Commonly used Fibonacci levels are the 236, 382, the 618, which is actually the golden ratio inverse, the 786, and the 1.618, which is the golden ratio. Now, to identify a swing high to low, like that's the first step, rule number 1, identifying if it's a swing high or swing low. So you would take the bottom of the trend and you would drag your fibs from here all the way to the top, giving you a swing low to a swing high, which then creates the fib levels that we see here. And you can see that each area has pivots around it, and that's what these are critical for, is like you're casting a net and kind of seeing where you're going to get traction. That's what fibs are used for. After mastering the common fibs, you will see traders refer to fib expansions and fib extensions. These are more advanced concepts that I will touch on later. But I'll just say right now that this 1.618 is considered like a fib expansion or extension, depending on an uptrend or downtrend. Fibonacci and trading. This sounds easy, but I see a lot of traders have a hard time knowing where to place fibs. So for me, I like to look at the daily and or weekly time frames to identify a swing low to a swing high, or vice versa. So you'll take a look over here on the right. Can someone tell me if this is what type of swing is this for fibs? Like, is it a swing low to high or a high to low? Anybody?
Low to high.
Yes, sir. And so you get the swing low because look at this. This is a huge reversal spot. So it signifies that's the low of the chart all the way to the high. Why they didn't take it higher is because after this relative high right here, you see a huge retracement down. That gives you the true sequence. And then the fibs, when you're trading on like TOS or TradingView, well, for TOS, I'm not sure, but for TradingView, I know the standard fib sequence will come with these color-coded, like highlighted levels, and that gives you a better example of like specifically identifying each fib from like the 618, the 5, or whatever it is, and that just helps stand out. And you can see like it gives you a zone for each. And so these help identify reversal points, entries, exits, stop loss levels, institutional buys and sells. Extra levels and relationships to pay attention to. So not all these fib levels are based off the Fibonacci numbers that we just talked about. Let me explain. So there's some imaginary levels. These are not levels derived from the fib sequence, but they're useful in trading. And so the first level I think of off the top of my head is the 50% fib. That's more of a psychological level, my bad. And so this 50% fib is an added fib. It's an imaginary level that simply shows a 50% retracement to help gauge the chart structure and trend. These are already placed in every fib sequence as more of a psychological level. And you can see like right here, this would be like a 50% fib. But there's other imaginary levels, which is like a 707, 886, and 114. All of these last three, I add to my fib sequence. Let me explain a little bit more. So my favorite fib is the 707. I added the 707 fib to my charts early when I first learned fibs. I never really saw anyone talk about it. And this guy I learned from primarily used the 707 for bounces or selling pressure, depending on the setup, depending on if it's an uptrend or downtrend. The further I dug, I found out this is an institutional area, the area where institutions are loading or selling. The 707 is also after the 618 fib. It doesn't matter if it's a swing high to low or vice versa. The 707 always comes after the 618 fib. For example, if you're trading off the 618 fib primarily, like most swing traders do, then market makers tend to have their way, knowing retail has that chart on their level. That level on their chart, my bad. The 707 gives you more of a buffer, so to speak. So that's why I'm always talking about the 707, because every trader is going to have that 618 fib, right? Institutions know that, but the 707, no one even talks about. No one even has heard of it. That's more of a safer area since it's further down below the 618 or above it, depending on an uptrend or downtrend. This gives you a more accurate level that algos fire on at. You will always hear me talking about the 707, and I see this play out time and time again. The way I like to think of fibs is you're turning on night vision to see in the dark, and it reveals the levels algos are trading at. At the end of the day, we're mostly trading against institutions with powerful computers, or algos, and they usually have their way with retail traders. I got to the point after mastering those fibs that I added the 886 and the 114, or as I like to call these two, the last resort fibs, right here. These are the last resort levels that a trend can hold before completely voiding the entire fib sequence. This is why they're either at the top or a bottom of a sequence, depending on the uptrend or downtrend. Now let me give you a real life example here. Let's take a look at, this is Hood Weekly. We've all been talking about Hood, trading it. pretty much all year. And you'll notice this is the weekly chart from a swing high from the IPO. It's only been around since like right before 2020. So this is a fairly new chart all the way to a swing low. And look at what we have here. You'll see that this, before it even created the swing low, it's already trading at this 114 level. So you get this hardcore rejection down, creating the low here. Then we've just chopped for like well over a year and a half just in this bottom. It's just basing pretty much down here. And look what we get. We get a bounce up to the 236, but then back down to this 114. And so for me, that's why I say it's like a last resort level, because it's throwing up flags, like red flags. It's signaling, okay, if we can bounce here, the trend can probably continue to go back and retrace these original levels. But if we lose that level, chances are it might not even hold down here at the 0 fib. It might even fall through. So that's why I call these last resorts. So if it's a downtrend, you'll see the 114 at the bottom. If it's an uptrend, the 114 is usually up here. So the inverse would mean the 886 is always on the opposite side of the 114. So then you'll see the 886 up here at the top. So let's get into relationships between support and resistance. Fibonacci levels can act as support and resistance depending on the trend. So if we're looking at an uptrend, you're going to want to use your fibs as support. And you'll see, like, just imagine, what if this is like a swing low to swing high here? This would probably be around a 50%. So you're looking at resistance, flipped support. This is where you'd want to go long in here off that 50% retracement. And it would be different for a downtrend. So say the chart's falling. Oh, my bad, let me go back. Say the chart's falling down. So you know it's a downtrend and we're just getting a bounce to test some levels. This is where you would want to use your fibs as a resistance point to continue that downward trend. Now let's dive into a little deeper to the practicality of fibs. Most people don't talk about this part. So there's extensions and there's also expansion levels based off of fibs. Try not to get caught up in the definitions for now, because I even have I'll mistake them sometimes when I'm talking. But here's how it works. Extensions identifies potential levels where price might find support or resistance during a retracement. Expansions identify potential targets in a trend continuation scenario. So let's see. Let's take a look at these charts real quick. So this is obviously a downtrend. And I tried to think of the worst stock I could think of, and that's you. We're always making fun of it. So I would take this fib sequence right here this is like when the chart IPO'd. So from this swing low to swing high, I get pretty much my original fib sequence that still plays out to this day. And you'll see, okay, we make this sequence, and then you get a nasty retracement all the way back down to the 88 fib that I've talked about. That's like a last resort fib, remember? That was good enough for a complete full retracement back up. But it was good enough up here, but it still wasn't good. So that's why these fibs are still in play, because it fell back down and completely wiped out all this previous range. But I still have this fibs on, because you can see that that's the extensions. So now this is where the extensions come in play. Here's all my basic fib sequence from the 0 to the 1 fib. But then once we place some extensions, which would be in a downtrend like I just talked about, the extensions would be a 1.72, a 1.414, and a 1.618. These give us price targets beyond our original sequence, and you can see here on you that it's already respecting these. Here's the 1, 2, 7, and you're getting a base around it. But eventually it falls back and breaks down, and then it tries to catch here at the 1.414. And this stock just had earnings like last week, and it's already like making more moves down. This is going to be a penny stock soon, is what I think. And so my last fib that I would look for a bounce would be this 1.618. And that's kind of looks like where it's headed. And so this is where extensions would come in play on this chart. Let me kind of talk about expansions now. See what I mean? Where you can get the definitions confused. So just try to understand the concept rather than the actual definition. For now, at least, until you get familiar with all this. So I thought of like the perfect uptrend scenario, right? What stock would come to mind for me? That's Nvidia. And that's where expansions come in play. So for expansions, you get the negative 236, negative 618, negative 786, and the negative 1.618. So let's take the low to high swing of Nvidia from 2022 to the high of 2023 last year. And that gives you a solid sequence here. But what do we do? Now we don't have any levels above, so how could anyone ever trade up here? This is why people use fibs. This gives us expansion levels when I add on those negative fibs that I just mentioned. And you can see, look at this. We get the first reaction here off my negative 236 on Nvidia, straight up to reject right here at the negative 618, but eventually it breaks up. You can see the PA around this 786 negative fib. All the way back up, back down to test this 618 negative. That's why anytime you see a 618, those are like the most hardcore Fibonacci levels and the most ones that are respected. And so this was a huge bounce recovery after a nice retracement from this top right here all the way back down. And what level do we have sitting up here at the top? That's a negative 1.618. And you can see like it was great enough for a huge bounce up. We tried to hold back down. And right now, this past week, this is the candle we put in. So to me, it's just trading in this like area of like maybe there's a support here off this previous peak. But other than that, it's kind of like in no man's land until it figures out which direction it's going to go. But that's where I love to use extensions and expansions. I would rather use this than draw like 100 different fibs. Like you could draw fibs here too, I guess. But to me, I'm still zooming out and referring to the original fib sequences that I try to place. That could be a lot to process, but the more you do it, the more you get familiar with it. So in summary, let me just nail it down. While both tools are used to predict future price levels based on past movements, expansion levels are used for determining where a current trend might extend after a pullback, and extension levels are used for identifying where a retracement might temporarily halt before resuming the initial trend. Like I said, right here, boom, boom, we get this little M, but maybe it catches here, or if not down here at the 1.68 to continue the initial trend up, because the initial trend was up until it just like died right here. Anyways, let's go on to the next. So let's see some levels in action. Let's look at some more charts here. So on this chart, you see there's a swing low to a swing high. And that actually gives us a nice bounce right here off this 50% fib, which is an imaginary fib. Remember, you got to remember that. So I'm iffy about 50% fibs because it's going to be a 50% chance, I take it, of like a bounce off, or it just is a bounce for a relief and then back down. But on this specific chart, you can see this psychological 50% fib aligns right here at this psychological 23 number. Let me go back. And that was good enough for a bounce right there. So the next step would be a golden zone, which people talk about. I always know where the golden zone is for every fib sequence on my charts. It's technically in between the 50% fib and the 618 fib. But I do it a little different. I have a different approach. And you'll hear me always mentioning the golden pocket. I consider the golden pocket from my 618 down to my 786. So it would include these three fibs right here, 618, 707, 786. That's what I consider a golden pocket. I like to think of this zone as more of a reversal zone. It doesn't matter if it's an uptrend or downtrend. It's game changing for swing traders who are looking to hold for bigger moves. And so this is the example I decided to share here. This is QCOM fibs, and this is QCOM COVID fibs. So you'll see a swing low from 2022 where COVID just crashed the market, but then we got this full recovery up to 2022. And look at how these levels play out. Bounce off my golden pocket. So we go all the way up, retrace down to this 618. It was fighting here for months to hold this level, because I still had imagined like it could come down to test the 707 or even the 786. But that's why I have these levels highlighted in gold. It tapped into it and just rocketed up. And you can still see like these other fib levels are still being respected. Look at this movement. It's a resistance support flip. Same here. You get this rejection down, but it's still caught here all the way back up. Then now we've just died for the past like month on QCOM, and it closed over this 236 fib. That's why I lean more bullish on it than bearish right now. And you can see these levels just play out over and over. So let's get into some market psychology. Traders tend to behave and behave differently around certain levels. So like when you think of psych levels, you think of whole numbers ending in 5 or 0, 100, 105, 110, 120. Some examples I can think of off the top of my head is Disney around 100, Nvidia right now around 100. And what happened? Big bounce. Disney rejected that 100. So you're always looking for these psychological levels as well, because it pertains right to fibs and moving averages. Market psychology and Fibonacci levels are intimately connected in trading, as they both reflect the underlying emotions of fear and greed. That drives like the movements of the market. So Fibonacci levels serve as psychological markers where traders anticipate support or resistance. These levels often increase buying and selling activity, not because of intrinsic properties or of the levels themselves, but because the traders are watching these levels simultaneously, making decisions based off them. This collective expectation and response reinforce the significance of Fibonacci levels, making them self-fulfilling prophecies, so to speak. Understanding this aspect of trading psychology can be crucial to improving your Fibonacci understanding and using them in your trading game. So let's get into charting some fib levels now. So it's pretty basic and self-explanatory. You would take how to draw a retracement is pretty easy. A swing low to swing high is just from a bottom to a top, 1 to 2. You can see that's an uptrend, clear. And the opposite would be a downtrend. So you see the market's pulling back, it created a top, and boom, it put in a bottom here, and it looks like it's recovering. This is confirmed fibs and how you would want to draw them. Now let's get into some advanced levels for harmonics. And so harmonics are like the final stage of fib traders, in my opinion. Like you graduate through these levels of like learning all these things, and you eventually stumble upon harmonics because it ties it all together. And so what is harmonics? Harmonics is a mathematical model that uses Fibonacci numbers and the golden ratio to predict price movements. Important levels that I've mentioned in the past, the 886, the 114, and harmonic traders have their eyes on these levels. You will notice measurements X, A, B, C, D. The distance in between these levels or patterns, it's critical for charting harmonics because essentially they're geometrical patterns. So they have to be respected. Like you see that these levels have certain measurements in between. And you'll notice, look, this one has 1.618 from the X point to the D point. That's a Fibonacci number. So that means that's a perfect pattern. That's why you'll notice this is how the market moves in all of these different types of patterns. And so based on the length in between these points, you will find patterns that fit the measurement, allowing you to properly define the harmonic as a bat shark, crab, butterfly, deep crab, and so on. In simple terms, it's all W's and M's, but knowing the name and the measurements is critical for harmonic traders because each one plays out a little different. You can find these in our resource and education channel, along with all these fibs charts that I've been mentioning. So some practical applications and some examples here. The main fib sequence I use on all charts is COVID fibs. And so let's kind of take a look more at that. Actually, let me go back. Bear with me here. Let me break it down a little bit more. So I love COVID fibs because this is where I think all traders should start at with these higher time frames and identifying the overall trends of the market rather than intraday and like, oh, what's happened the past week, because it's easier to see what's happening over the past year. And so I always say, let's start with COVID fibs. And why COVID fibs? The most recent fibs range that I see respected on all charts to this day, on higher time frames, lower time frames, is COVID fibs. I leave my COVID fibs levels on permanently in white on my charts, and this is what helps me gauge overall trend and sentiment. The reason why it's important is because most charts are still trading in this range and have not broken out. Furthermore, COVID was the most volatile the markets have been over the past 10 years, setting a true range that is still respected. Even if the chart breaks above or below this range, price action still respects these levels. And so COVID high on any chart is telling because this is the most recent high on most charts and a level that I see play over and over again. If the chart breaks above COVID high, you will still see price action come back down to test these fibs, or even fall back below and test the fibs right under the COVID high, as all charts come back and retest levels eventually. And Nvidia is a perfect example, right? It ran up and now we're trading back at COVID highs. Let's take a look at SPY Weekly. This is a real great example here. So how I do it is I like to take the low of April. This is the clear end of the market crash of COVID. Look at this. It set a horrible new low. The market hasn't seen that since for years, 2016 or so. So we take that low from COVID of April 2020. We take it to the peak of pretty much right before 2022 because it's just a straight line up pretty much. So that gives you a true COVID fib sequence. And look what happens. As soon as we peaked here, boom, we come back down, we lose this 114 fib. We bounce at the 236. Where do we reject? My last resort fib. So this is the 114 and then back down to the 382, but that's not even good enough. See how it moves in these patterns? It's like bouncing off this previous one, rejecting the one on top. Bouncing off the lower one, rejecting the one we were just at. It's all support, resistance flips. Was support, now it's resistance here. Comes back down to this imaginary 50% fib. That's why you got to keep an eye on this one, because it could just pop out of nowhere. And so when you have a strong market like SPY, which consists of the 7 biggest stocks, if not more, like all the 500 top companies, but I'm talking about like the top 7 companies move this stock. And so that's good enough right here to the 50% fib to just, that's all it needed. That 50% retracement and it was back up. You stalled here again at the 114. Like I say, this level's key. And then boom, back down to the 236 to eventually start going up. And so this is why like I just preach COVID fibs. To me, there's no other, like it's the best way. It gives you your levels, your macro levels. And then if you can hand chart in between or do whatever other strategy you have, then you have a good idea of sentiment. Like this is a clear bull market. Even down here off the 50, it's bull market. Even a bounce off the golden pocket, it's still a bull market. I would consider it to be bearish if it started losing the 886 down here and maybe the 786. And you can see, look at that. That's just like, that's ridiculous. So from 360 and we're trading at 540 now. That's insane. Let's take another example here. So here's Amazon daily. So 2020, we created, this is my COVID fibs. 2020, we created this swing low from COVID. We crashed. And notice the first peak. So I take it all the way up to this first peak right here. And the reason is because after the first peak, you can see price retraces down. You see that? That's a big move off this high, back down. And it even falls down through the next fib. So the 114 wasn't good enough. Look at this gap it created. Boom, it just completely wiped that out. All the way down to the 236, which it just traded around for a while. This creates a new trend right here. That tells you, look, there's a complete clear structure shift that we're noticing. And so you can see another reject after it based down here off the 236 back up to this COVID high. That's why I wouldn't put the COVID high right here. It matters only a few dollars, but like you'll see it play out. Like, so I'd rather put it there because it respects that perfectly for another rejection right here. And you got to remember, everything is situational. So you have to have some intuition kick on and like kind of tell you like there's no perfect way to do it. You're just trying to catch what the algo's trading on. And that's why you can play it around, like maybe put it here and see where it is. But after putting it there, this gives me my infamous 1888 COVID high on Amazon. I'm always talking about it. Look at this. 18800 to a T is COVID high. What happens after we peaked for the second time? It wasn't good enough to break through. So this was a nice retracement bounce, like a relief bounce. That's the way I look at it. As soon as we got back up here, the market completely crashed. Well, at least for Amazon it did. For a whole year, we're just trading down. And this is where it gets rocky. So look at this 886. This is where you're like, oh man, Amazon's going to zero. But eventually, where does it catch? Right at the 1 fib. So exactly the low of COVID. And then we've just been rocketing up ever since. Giving me my levels that are still in play today. Because look at this. Resistance, resistance, resistance. That's Jeff Bezos up here. And then it breaks through. And then Jeff holds us down and sells all the stock back down. Tries to come back here, 188, can't do it. Now we're just trading in this zone. So to me, like anytime you're in between these, it's just like basing. So it's just not really doing much. So since April, what has Amazon done? Nothing. So that's hard terrain for swings. See what I'm saying? That's why I like to gauge COVID fibs. You need to remember it's all situational, like I said, and you got to use some intuition when you're laying your COVID fibs. So one of the best examples I like to think of is crypto, because it's like all algo trading and bots that are trading it. So Bitcoin loves fibs, and maybe the best example, let's look at the monthly chart right here on Bitcoin. So I get that swing low from COVID 2020 to the swing high, and I put it right here at this high because like I said, what happens when we hit here? Complete retracement. Back down past the 50 fib even. But then we get a relief bounce off that 50 fib to come create a new high. Some people would put their high to low here. I don't. That's not how I like to do it. Because it only wicks up into this level. There's no body closes on the monthly. So it tells me like this structure is completely being respected by algos still. So there's no reason to move it. And then what happens? For the second rejection off this COVID high, we come all the way back down into my golden pocket, the 618, 707, 786. And what happens? We finally bounce off this 786, and it's just been mooning pretty much ever since 2023, all the way up. And look at where we are these past 5 months. It's just basing. So you're just basing over COVID highs 1, 2, 3, 4, 5 months in a row. Just straight. So to me, this is like I lean bullish. It looks like this is gonna rocket up. If not, it's gonna be a horrible collapse back down. And so this is where you'll notice the high is respected through 2021 and 2022, never breaking above, only wicking, as I said. And so that leads me to adding the expansion level up here that you'll notice I have. That's a negative 236. And so I like to just add expansions and extensions instead of adding like a bunch of little fib sequences in here and here, because those are harder to track the algos. The algo's obviously trading off this fib sequence from COVID still. So I added my expansion here, like I said. And that gives me a clear price target ahead because you have no levels up here. So how do you even trade that? Maybe right here you have a peak. Yeah. And then maybe these are closing below this peak. That gives me a clear target of 79K right up above. And with these monthly candles, look at this. That could be there in a month. It could be there in 3 months. It could be there in a week with how Bitcoin trades. And so that's how I like to use my fibs. And so that 236 fib up here is what I would call like a complete measured move. So it's a complete measured move from the 0 fib up to the negative 236, giving you that perfect price target. So if you're just accumulating Bitcoin up through this past 5 months and we rock it up, then you're in good hands. All right, let's do some live drawing on a chart. So give me a second here. I'm going to switch over to TradingView. All right, can you guys see TradingView? Anybody?
Yes, sir. You're killing it, by the way.
Thanks, man. All right, so let's do some TradingView watch. Let's do coin, since I love this one. So this one's tricky because you'll see from the IPO in 2021, you just get this like cup and then handle breaks down. And so it's always hard to gauge the COVID fibs on any chart that's like IPO'd right during that time. You know what I mean? So it's like you have no history previously to even go off of. So a way I'd like to do this is pretty much you could take a COVID here to here or like a here to here, but we want to get the full sequence. So to me, it's like, okay, I see a peak here and we've never gotten back up there, and I see a low down here. So the way I would like to draw this is like this. And look at this. Like I say, I suggest highlighting my golden pocket in gold on charts. And look at how this sequence plays out. So we're looking at the weekly right now too. And you'll see we get this full move down, creates this low. We're basing around my 114 fib here. We get the resistance, flip to support here, and then we're just straight up. But look, we come back down and test. Even right here, people may have been waiting for the retest of the 236. To me, that's good enough because I always think of these levels as magnets. So it's like they're not going to be hard spots. It's going to be a magnet. So you got to give it some area, like a little buffer on top and bottom of each level, because it's always going to magnet around these. Like up here, perfect example, we shoot up, but still going to magnet down. And we even came back down here. So it's like more of reference points than actual hard levels. And you can see ever since we got up here on COVID into my 707, we've been struggling. And that's why I say it's an institutional level. They're holding it down below that. So you just see huge selling at the 707. And no one even really talks about the 707 or has that on their fib sequence. And that's the perfect golden pocket to me, because boom, this told you, the chart's been telling us for weeks coin's gonna have a hard time up here. That's why I haven't really been playing it for the past few months, just here and there on little pops. But look, we come to the 707, doesn't hold. We come back down to the 50% fib, the imaginary fib, and you can already see how reaction is around here already. There's a bunch of accumulation. Same thing here. So the last time we were here, resistance, but we got that flip support. You can't be fooled, because the second retest of the 707 area was a complete disaster. And boom, look at these sells off of it. huge sells. Even the 50% fib here couldn't hold again. And then this past week, nasty earnings candle down to the 382. But look at where we wicked up to, this 50 fib. And it's just trade. So to me, I'm like, this is in no man's land really, until it decides like, okay, do we want to get over 200? I need to see some closes, and then I'd be confident of like maybe we go back up. But now you're just created a completely new pattern. This is like a downtrend, if you ask me, ever since we tapped into this first 707 retracement. And that's why I always say like the golden pocket, COVID fibs, highlighting these three levels, it tells you everything you need to know. So everyone up here who was smart was selling. And actually, this is like in February, yeah. So my best months on coin were February, March, when I was catching these rips up here. Like this one, back down and up here. And then I haven't really played it since. Because the chart's telling you it's not really primed until it figures out what direction it wants to go. That's where harmonics would come in play. Some could argue that this is an M setting up and it's not even completed. So if it was like a deep crab M, this could all come back down to even lose this 100 level. But to me, I'm looking more at like this 160 or below for it to complete. Maybe it catches right here where you see some price action right there. But you see what I'm saying, guys? Like this is how it plays out over and over again. So someone give me a chart and I'll look up one. Anyone?
Did you look at IWM COVID fibs?
Sure. All right, so this is like a clear one here. And you'll see it better on the indices, I think. Like, because it's just, indices get destroyed when there's any crash or, you know what I mean. So let's take a look here. This COVID crash was nasty because you get gaps in the weekly chart. That is scary. So we'll take the low. And so I would put it, some would put it here. This is where you have to have some like intuition of where you'd play it. Like some could put it here because of all the rejects you get off of it, but I see body closes above, so I like to put it here. And so look at what we get. We get this full move up back down to the 50 fib, and it's just been accumulating ever since 2022. That's why everyone jokes like IWM's done nothing for 3 years pretty much, and it's just straight, just accumulating in between these two fibs. And finally we got the move up, but look at where we stalled. 227. And I remember this day I was holding on this is when I closed out my swing. And so this was a nasty wick up, and then look at what happened like the past couple weeks. It died back under this, all the way back under the 236. And now I'm like, it needs to prove it. Like you can come in here and do some hand charting and be like, oh, let's see here. There's a nice resistance trying to flip support in here. And that's like 196. And I'd say probably around like 200. So it needs to get above. But like I said, you can see these levels play out. Maybe it needs to come back down and retest this golden pocket to get a true move up. Because after all, I mean, this is small caps. So like if the market's struggling, small caps are going to be the worst. And they're the most rate dependent. So it's like that move down makes complete sense off all this bad news we've got recently. Why would IWM just continue to go while SPY and Q are dying? It makes no sense. And that's why I say the last resort fib, 114, we couldn't get over that. And now we're back down. So now it's like we need to just see how this plays out. But you can see these COVID fibs in play again. I'll do one more chart if anyone wants to throw one out. watch. Let's see if I can find one. Netflix is a good one. So this one is kind of hard. Let's see here. All right. So I tried to think of like COVID started March 2020 through 2021. Most people would take this high to low. You can do that too. But look, it's still trading on my fib sequence. We even lost this whole fib sequence, but let me show you an example of what I like to do. Oh, it's not working. Watch. This is where the expansions and extensions come in play. So I still think it's respecting this original fib sequence. You can see the golden pocket broke down. When we came back down, it like just died. This is 2021. So it slow grinded up all the way, but then look at this knife down. Where did it catch? Right at my 1.272. So to me, it's like, okay, you could void out this COVID fib sequence, but since it rocketed back off this fib here, came back and reclaimed the low of 2020, still traded in the golden pocket for another bounce back up to COVID high. Like, it's still trading on the sequence to me, and you can still see bounce off 382, rejection before it flipped support here at the 50%. But like here at the last resort fib that I talk about, couldn't hold on. Now we're back here to the 236. So to me, like, these COVID fibs will play out on every chart, and then you could even put expansions and extensions above. So I could even add ones above if I'm like, okay, maybe we get a crazy move up here. Put your negative 236, your negative 618 back on, and that would give me clear long term, like around 800. So to me, this is better than trying to put like every little fib sequence on, because then you're like, oh, let's put a fib here and here. Then you start getting clustered. Like, it's just, there's too much going on, and then you're just like, you're not looking at the macro of the market. That's the way I look at it. So let me go back to the PowerPoint here. All right, we back on the point? Think so. So some common mistakes: not identifying the correct swing points, like I just talked about.
I don't think you're streaming it.
All right, let's see. How about now? Should be good. My bad. So yeah, the common things are like not setting your initial swing low to high or high to low, not knowing when to void it. It's very rare to void a COVID fib sequence. That's why I'm saying, like, I'm talking about macro fibs right now. There's a different approach when you're doing intraday fibs and all that other stuff. It's way more complex. That's what I think. So to me, starting off with the COVID fibs is the first step if you want to be a fibs trader. Mistake 2, ignoring other market factors, data, earnings reports, or news. All of these help solidify these levels or give it fuel. Like, there's always the debate of chart makes the news, news makes charts. That's up for you guys to debate. But all I know is these COVID fibs play out, and you got to factor in earnings and news and data. It's not going to just go in straight lines. They're always pivot points, and it's chop around, and those are magnet levels. That's the way I like to think of it. So my tips, higher time frames are key. I'm always preaching that. But you got to remember, I'm a swing trader, so I'm always looking for longer holds on my plays. And the best practices are always referring back to your daily, weekly, monthly. So let's kind of do a recap here. Fibs retracement is a powerful tool for identifying market turning points. This leads to making informed trading decisions. The correct application and understanding can improve market analysis and your trading strategy. Higher time frames is key, like I said. It's less convoluted, and compared to other lower time frames, like that's when it can kind of get to be a bunch on your chart, is when you have just fibs everywhere. Then it's like you just don't even know what you're referring to at that point. And that's why I like to say, like, have your macro fibs set, and then you can hand chart the rest. And it's not like you can't use other fibs, but all the other fibs should just be used for confluence to what you already have charted. That's the way I look at it. And that's the presentation. So I'll open it up now to some questions if you guys have any. Or if you have a certain chart you want me to look at.